world of interest rates now is uncertain.
Yeah.
Right.
Yeah.
What does that matter? So we always hear about interest rates,
Right.
and from a from an economic perspective, I get it.
Mm-hmm.
What do you look at interest rates? What do they mean to you? What should they mean to us?
Sure. It's a cost of money, right? So let's go back to '07. The housing market's been flying off. It's doing great. People are buying homes and getting mortgages for no money down, pretty much. And then the market crashes a bit, right? '08, the great financial crisis. And what the Fed then did was to do, and it's been an experiment. It was never done before, and it was globally concerted. It was, lowering interest rates to zero. And then buying back bonds, QE, quantitative easing, never before in our lexicon. But QE1, QE2, QE3. Essentially what the Fed did was to flood the economy with money. And thinking that if the more money is out there, that will make things easier, and that will pave the way, and that will be fine. And they did huge. I mean, they went from a $800 billion balance sheet to a $4 trillion balance sheet. I mean, that's an expansion. Never been done before. Now they're unwinding that.
Yeah, so they're selling a bunch of bonds. They're $30 billion a month or something, right?
And my view is the likelihood of that ending, this experiment, going without a hiccup, is unlikely. There's going to be some hiccup, because the old adage that Warren Buffett enjoys is that when the tide goes in, rather when the tide goes out, you notice who's swimming naked.
Yes.
And right now there have been a lot of companies and individuals who were able to do things through low interest rates and low cost of money, that when the price of that money goes up, in other words, when interest rates go up, they're upside down on issues. And they can't finance and they can't pay their bills, and they're too leveraged. And that's when problems occur.